All right, let's talk about competitive equilibrium and long-run supply. So up to now, we've been talking about short-run supply. Now we want to make a distinction, see what happens in the long run, and that's the period when the firms can adjust all of their inputs and entry and exit can occur. So what does long-run competitive equilibrium look like? Well, the idea here and the important issue is that in the long run, firms can enter and exit in response to profitability. That means, for example, that if firms that are in there are profitable, firms that are thinking about getting in can see that or sense it somehow, and they get in too, which is going to then shift supply out. If the firms that are in the market are unprofitable, then some of them can exit. That'll contract supply, raise prices, and leave the remaining firms just borderline profitable. Well, that kind of logic gives rise to an equilibrium, and here are the conditions for the equilibrium in the long run. First of all, each of the firms is maximizing profits. So it's doing that process we described earlier, choosing the quantity where price equals marginal cost. In the market, price equates supply and demand. So there's a market supply and market demand. Market supply resulting from each of the individual firms, and the market demand along the lines we've always talked about. And price equates supply and demand, and of course that's the price that feeds back to these firms that they face when they make their profit maximizing output decisions. Finally, in equilibrium there are zero profits, and so that means no firm has an incentive to enter or exit. Again, if there weren't zero profits, if there were positive profits, then some potential firms would like to get into also get some of those profits. If there were negative profits, then in the long run some firms would need to exit in order to bring the profits back to zero. All right, so what does the picture look like? Well, let's start with a picture with positive profits. So this is a short-run situation, a situation with positive profits. And what does that do? It attracts entry. What does entry mean? Well, entry means more firms that look like this firm on the left. And I should say, in case it's not already clear, that the picture on the left is the picture of a firm. And the picture on the right is a picture of market. So the market has the market supply and demand, but on the left we have a firm's average cost curve and marginal cost curve. In any event, in this short-run equilibrium, we have price being determined here, and that price feeds back to all the firms. Each firm chooses its output at the intersection of price and marginal cost, and so there's this firm's optimal quantity of output. But because the price is above average cost, there are profits. This vertical distance is the profit per unit, and this whole blue rectangle is the profit for this firm. Now that profit attracts entry. So what does entry do? Well, that means other firms looking like, let's say, this firm enter, and that's going to shift supply out. How does market supply react? Well, shifts out, and in the end, we have a new intersection here. And the price that gets determined there is the minimum of long-run average cost. So we started in a disequilibrium. It was a short-run equilibrium, but there were profits. It attracted entry. The long-run equilibrium has a market price determined by an intersection of supply and demand, so over here, at a price that's the minimum of the average cost. So that's a picture of long-run equilibrium. Now, we've said this long-run equilibrium has zero profits. And, zero profits is kind of scary, especially at a business school. But I wanted to mention as an important aside that it is possible to make money, even as a price taker, in product markets if you have lower costs than other firms. Think about Walmart. We've thought about them before, but how do they make money? And it's not really by charging higher prices. It's because they have lower costs than other firms. And just to illustrate the idea that Walmart, although they're huge, it's not like they're going to be a monopolist or something. No, instead, they make their money by having lower costs. So let me show you what I mean. It's just a little bit of data on milk prices. So this is milk prices per gallon by store type. And so, for example, we have skim here, low fat, whole. These store types, the so-called non-traditional retailers are Walmart and Target, whereas grocery stores are, well, they're grocery stores. So look, for example, at the price per gallon for skim milk. And in any of these years listed here, grocery stores here are $2.32 a gallon in 2003, whereas the Walmart Target type stores are $2.07. For low fat, it's $2.41 versus $2.28. For whole milk, it's $2.63 versus $2.53. Now, grocery margins don't tend to be that big, so these price differences are actually pretty substantial. All right, so summing up on this slide, you can see that Walmart, although they're selling a product that's identical to the product elsewhere, in this case we're talking about milk, they're not making money by charging higher prices. They're making money because they have lower costs. Now here we have a link to what you may have learned in a strategy course. And the idea here is this equilibrium need not be bad news. A firm can still be profitable even in this kind of an equilibrium. If you're a firm selling the same things as other firms, you can still be profitable if you have lower costs. But the last point's important. You have to have lower costs in a way that other firms cannot successfully imitate. Well, we saw that Walmart diffusion map a while ago, and it is pretty hard to imitate what Walmart's doing. So indeed, even though Walmart's selling homogeneous products, it's doing so in a way that's profitable for them in equilibrium. And you'll have a problem on the problem set this week that asks you to think about a related situation. All right, let's talk about long-run supply. So we've already talked about the short-run supply curve, and that was just the firm's marginal cost curve above average variable cost. It showed the relationship between the price that prevailed in the market and the optimal amount or profit maximizing amount for the individual to produce. Long-run supply is a little bit of a different thought experiment. What we're asking here is what happens to costs if there's a permanent increase in demand? And so here, imagine changing demand, and then let's let entry, an exit or whatever occur and see what the new equilibrium looks like after let's say the permanent increase in demand. Now there are a couple of different cases. One case we call constant costs. And here, when there's an increase in demand, it does not drive up the price of inputs. And let's just show you then how that plays out. So what I have in this picture is on the right-hand side I have the market, and I have demand and supply and a few different things that I'll talk about in a second. On the left-hand side I have the firm. Okay, and so this is just one of the many firms, all of which, let's say for now, are identical. So first thing that happens is, let's say demand shifts out from D1 to D2. Now as a result of that, the price rises from P1 to P2. This is the short-run response along this supply curve. So price goes up. Now when price goes up, then at each individual firm, the optimal thing to do goes from this little Q1 to this Q2, because now at this higher price, the intersection of price and marginal cost is up here, and there are profits. But profits attract entry. Now entry causes supply to shift out to the right, and where this process ends is that supply shifts all the way back down to here. Now how do I know it shifts all the way back down to here? Well, what we said for this example, which by the way was called constant costs, we said that here the expansion of the industry, and notice that the industry output used to be here and now it's way over to here, the expansion of the industry did not cause a driving up of the input prices. So we end up at the same long-run average cost curve that we were originally at. What's different though is that there are more firms in the industry. Remember, this is a picture of a particular firm, so in the new equilibrium there are just a bunch more of these, but the structure of costs hasn't changed. So the equilibrium price comes back down to what it used to be, and here it is on this green line. Now to get the long-run supply curve, what we literally do is we connect this equilibrium with this equilibrium, connect those dots, and this orange line is the long-run supply curve. Because this is the constant cost case, you see the long-run supply curve is just horizontal. Let's think about a different case with increasing costs. So how's this going to work? Well, here the idea is going to be that the increase in the output of the industry, when there's a permanent increase in demand, actually drives up the price of inputs. So some of the inputs are literally scarce. When there's more demand for them, they become more costly. And that means the new equilibrium at the higher scale of output for the industry has higher costs. So what does that look like? Well, we start with a picture, much like what we had before. So we had an equilibrium here. This was industry output. And here, of course, is the price, and this is what it looks like at a firm. Then demand shifts out. So demand shifts out to D2. The price rises. And so Now we're going to see some profits, and there will be some entry in response to that. But the question is, what happens to supply when the entry occurs? Well, supply shifts out, but I guess the real question is, where does it settle down? Because the scale of the industry is expanding, the costs of the inputs rise. And so instead of this old orange long-run average cost curve, now we have this orange dashed long-run average cost curve. Notice that it's higher. That means that supply isn't going to settle all the way back down. Instead, supply settles down to here. So the intersection of supply and the new demand curve is here, whereas the old intersection of supply and demand was here. If we connect those dots, we have a long-run supply curve that's upward sloping. So this is the increasing costs case, and it's the case in which the long-run supply curve is upward sloping. And once again, the story's pretty intuitive here. If the situation is such that a permanent increase in the quantity of output in this industry drives up the price of inputs, then when a bunch more firms enter, instead of being on this old average cost curve, we end up on this new higher orange average cost curve. And so prices don't settle all the way back down to here. They settle down to here. So this idea of increasing long-run costs or an upward sloping supply curve in the long run is very current. I mean, a lot of things are happening in the world that give rise to phenomena like this. One is that there are a lot of natural resources, and as the world's demand for them increases, we have to kind of look at less and less cost-effective places for getting it. And so oil is a nice example, an interesting article by Paul Krugman a few years ago talking about a finite world. I'll just quote here briefly. Oil is back above $90 a barrel. Copper and cotton have hit record highs. Wheat and corn prices are way up. Overall, world commodity prices have risen by a quarter in the past 6 months. What the commodity markets are telling us is that we're living in a finite world in which the rapid growth of emerging economies is placing pressure on limited supplies of raw materials, pushing up their prices. And America is, for the most part, just a bystander in this story. Now, how else can we see this? Well, think about the rapid growth in China and India. And here are pictures of the Tata and the Chery, two of the small cars that are growing quickly in China and India. And what's going on is that just a lot more people are interested in buying things like gasoline. And as more and more people want to buy gasoline, that in order to expand the output of that industry, it's necessary to work with more and more costly places for getting it. And so it's driving up the price of those inputs, which in turn is driving up prices of things that use gasoline, like food. So long-run supply is a very current phenomenon, very interesting phenomenon. All right, what are the takeaways? So the first, and this is on the topic of the long-run supply curve, really, and long-run competitive equilibrium. So the first is that profits attract entry, which then leads after adjustment to a zero-profit equilibrium, and it's zero profits for all folks involved unless they have a cost advantage, and again, you'll think about that in the Walco problem on the problem set. Long-run supply, the shape of that curve, depends on what happens to input prices as the market expands. If a higher scale of output makes inputs more costly, then the long-run supply curve slopes up. And indeed, we are living in interesting times where we're seeing a fair bit of this.